You can earn more money and still stay broke. You can get a raise, move into a better apartment, buy a nicer car, and even have more money coming into your bank account every month. And somehow, 10 years later, still have almost nothing to show for it. That's because building wealth isn't just about how much money you make. It's about what happens to that money after you earn it. And some money habits are so normal that you don't even recognize them as habits anymore. In fact, the latest Federal Reserve data shows that 16% of American adults didn't pay all of their bills in the previous month, while only 63% said they could cover a $400 emergency using cash or its equivalent. So today, we're going to look at 11 money habits that can quietly keep you poor, and more importantly, what the math says you should do instead. Habit number 1, spending your raise before you get it. Imagine you make $60,000 a year. You get a raise. Now you're making $70,000. You feel richer, so you upgrade the apartment, then the car, then the restaurants, then the vacations. And somehow you still have no money. This is lifestyle inflation. The dangerous part is that it doesn't feel like you're spending too much. Every individual purchase seems reasonable. But collectively, your lifestyle quietly expands until it consumes your entire income. And this is exactly why a bigger paycheck doesn't automatically create wealth. Here's the rule. When your income increases, don't immediately increase your lifestyle by the same amount. If your salary goes up by $10,000, try living as if you only got a raise by $5,000. Invest the other $5,000. Because the goal isn't to look richer every year. The goal is to actually become richer every year. Habit number 2, treating your credit limit like income. Your bank gives you a $15,000 credit limit. Your brain starts thinking, I have $15,000 available. No, you have $15,000 available to borrow. Those are completely different things. And Americans are borrowing at enormous scale. The New York Fed reported that total U.S. household debt reached approximately $18.8 trillion in the first quarter of 2026, with credit card balances alone at about $1.25 trillion. And credit card debt is particularly dangerous because the interest rate can destroy your wealth from the opposite direction. The Federal Reserve's latest data shows credit card accounts being charged interest were averaging roughly 21.5% in the latest reported period. Think about what that means. If you carry $10,000 of credit card debt at roughly 21.5%, you're dealing with more than $2,000 of interest in a year before you've meaningfully reduced the principal. That's money that could have been buying assets. Instead, it's paying someone else's return. So stop asking, how much can I afford per month? Ask, can I afford this without borrowing money? That one question can save you years of financial pain. Habit number 3, buying things to prove you can afford them. There's a strange trap that happens when people start making more money. They don't just want to be wealthy, they want to look wealthy. The new car, the expensive watch, the designer clothes, the luxury apartment, the vacation photos. And here's the problem. The people you're trying to impress usually don't know how much debt you're carrying. They see the car, they don't see the loan. They see the watch, they don't see the credit card statement. They see the vacation, they don't see the 6 months of payments waiting when you get home. That's why one of the most powerful financial habits is learning to separate wealth from appearance. A person with a $50,000 car and $2,000 in savings isn't necessarily wealthy. A person driving a 10-year-old car with $100,000 invested might be much closer. One is buying an image, the other is buying freedom, and freedom doesn't need a logo. Habit number 4, having no emergency buffer. Here's one of the scariest financial situations you can be in. Everything is going fine. Your paycheck arrives, your bills are paid, your credit card works, and then your car breaks down, or your hours get cut, or your water heater dies, or you suddenly have a medical bill. Now you don't have a money problem, you have a timing problem. You need $1,500 today, but your next paycheck comes in 2 weeks. So you put it on a credit card. Then the balance stays there. Then interest starts accumulating. And the emergency that should have cost $1,500 becomes much more expensive. The Federal Reserve's 2025 Household Survey found that 59% of adults experienced at least one major unexpected expense during the year. The most common was a major vehicle repair or replacement. That's why an emergency fund isn't money sitting around doing nothing. It's insurance against bad timing. Start with your first $1,000, then build towards 1 month of essential expenses. Eventually, work towards 3 months or more depending on your situation. Because when life punches you, you don't want your first response to be which credit card still has room. Habit number 5, saving whatever is left over. Most people have a financial system that looks like this. Paycheck comes in, bills go out. Food, shopping, subscriptions, restaurants, random purchases, and then at the end of the month, whatever remains gets saved. The problem? Sometimes nothing remains. So flip the system. When your paycheck arrives, move money toward your future before your lifestyle gets a chance to spend it. Even 10% can be a powerful starting point. Imagine someone invests $500 every month and earns an average 8% annual return over 30 years. They contribute $180,000 of their own money, but the account could grow to roughly $745,000. The market would have generated more than $500,000 of the final balance. That's the power of giving your money time. And that's why saving isn't just about discipline, it's about automation. If you have to make the decision every month, eventually you'll get tired. If the money moves automatically, you don't have to negotiate with yourself. Habit number 6, confusing cheap with smart. Being cheap sounds like good financial advice, but sometimes the cheapest option is actually the most expensive option. Imagine you buy a $20 pair of shoes that falls apart every couple of months. You replace them again and again and again. Meanwhile, someone spends $100 on a durable pair and keeps them for years. You saved $80 and somehow spent more money. The same thing happens with cars, appliances, tools, education, software, professional services, and even your own time. The goal isn't to buy the cheapest thing. The goal is to get the best value for the money. And there's another cost people completely ignore: your time. If you spend 3 hours trying to save $15, you didn't necessarily save money. You traded 3 hours of your life for $15. Smart financial decisions consider both. Habit number 7, letting small recurring expenses become invisible. Here's a dangerous sentence. It's only $10. $10 doesn't sound important. $15 doesn't sound important. $25 doesn't sound important. But stack enough only $10 expenses together, and suddenly you're spending hundreds every month without noticing. Let's say you have $15 for one subscription, $20 for another, $12 for another, $30 for an app, $25 for memberships, and another $50 disappearing through services you barely use. That's $152 a month, almost $1,824 a year. But the real cost is bigger. If you invested that $152 every month for 30 years at 8%, it could grow to roughly $226,000. That's the part people don't see. A recurring expense isn't just costing you today. It can also cost you decades of future compounding. So once every few months, open your bank and credit card statements. Don't guess where your money went. Look at it. Because money you can't see is money you can't control. Habit number 8, waiting for the perfect time to invest. A lot of people say, I'll start investing when I make more. Then they get a raise. I'll start when the market crashes. Then the market keeps rising. I'll start when I understand everything. And 5 years later, they still haven't started. The problem is that investing rewards time more than perfection. Let's take a simple example. Someone invests $500 a month starting at 25. Another person waits until 35 and invests the same $500 every month. Assume an 8% annual average return. The person who starts at 25 could end up with roughly $1.5 million by age 65. The person who starts at 35 could have around $745,000. Same monthly investment, same hypothetical return, different starting date. That's why time is one of the most valuable assets you have. And you don't need to predict the next great stock. You need to build the habit of owning productive assets consistently. For 2026, the IRS allows up to $24,500 in employee 401k contributions and $7,500 in IRA contributions. You don't need to max those accounts out immediately, but you should know that these tools exist because investing isn't something you do after becoming rich. For many people, investing is part of how they become rich. Habit number 9, increasing spending faster than income. There's a subtle difference between earning more money and becoming wealthier. Suppose your income increases by $20,000, but your lifestyle increases by $22,000. Congratulations, you got a raise and somehow became poorer. This is why you should track one number, your savings rate. Not just your salary, not just your bank balance, your savings rate. If you earn $6,000 a month and spend $5,800, you're keeping only $200. That's about 3.3%. If you earn $4,000 and spend $3,200, you're keeping $800. That's 20%. The second person earns less but is building wealth faster relative to income. Income matters, but the gap between what you earn and what you spend is where wealth begins. Habit number 10, ignoring your taxes. Taxes are one of the biggest expenses many people will deal with over their lifetime, but there's a major difference between avoiding taxes illegally and understanding the legal rules that already exist. Retirement accounts, tax deductions, tax credits, health savings accounts, education accounts, different investment structures. These aren't loopholes you need to be a billionaire to understand. They're part of the financial system. For example, the IRS increased the 2026 employee 401k contribution to $24,500 and IRA limit to $7,500. That doesn't mean everyone should contribute the maximum immediately. It means you shouldn't ignore the tax system while trying to build wealth. Because here's the uncomfortable truth. If you don't understand the rules, you're still playing the game. You're just letting somebody else make more of the decisions for you. Habit number 11, focusing only on saving instead of growing your income. This might be the biggest one. You can spend hours looking for a $5 discount. You can compare grocery prices, cancel subscriptions, use coupons, cut restaurant spending. And yes, those things matter, but eventually there's a limit to how much you can cut. You can't reduce your rent to zero. You can't reduce food spending to zero. You can't eliminate every expense. But your income doesn't have the same ceiling. You can learn a valuable skill, negotiate your salary, change careers, build a business, start a side income, create something people are willing to pay for, and then invest the difference. Think about the math. If you save an extra $200 a month, that's $2,400 a year. Useful. But if you increase your income by $20,000 a year and keep half of that increase, you've created $10,000 of additional annual cash flow. That's why wealth building has two sides. Reduce the leaks, increase the engine. Do both. And here's the thing. None of these habits will destroy your finances overnight. That's what makes them dangerous. It's the $20 subscription, the minimum credit card payment, the unnecessary upgrade, the car loan, the raise that immediately becomes a bigger lifestyle, the investment you keep saying you'll start next year. Each decision looks tiny, but wealth is built the same way. Tiny decisions repeated for years. The Federal Reserve's latest survey found that only 35% of non-retired adults thought their retirement savings plan was on track. That should tell you something. Most people don't suddenly wake up at 60 and realize they made one gigantic financial mistake. It's usually thousands of tiny decisions that slowly push them in one direction. And the good news is you can reverse that direction. You don't need to become a millionaire this month. You don't need a perfect portfolio. You don't need to stop enjoying your life. You just need to stop making decisions that your future self will have to pay for. So automate your savings. Kill expensive debt. Build an emergency buffer. Stop buying status. Track where your money actually goes. Invest consistently. Use the tax advantages available to you. And most importantly, make sure your income grows faster than your lifestyle. Because the goal of money isn't to prove something to other people. The goal is to buy something far more valuable. Options. The option to leave a job you hate. The option to handle an emergency without panic. The option to help your family. The option to retire when you choose. And eventually, the option to wake up and realize that your money is working harder than you are. That's what building wealth actually looks like. Not looking rich, becoming free.